Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, Mo Dawood and I, instead of interviewing a guest or interviewing each other, what we're going to do is a discussion about the collapse or the waterfall decline in the paper precious metals markets, how that's differing, how there's a humongous divergence between the real physical market, and then we're going to talk about the miners and how this affects the miners, and then how this is going to affect the financing for precious metals and the physical market 3 to 5 years from now. So, Mo, what is your opinion then of what happened last Friday and then Monday? How did all this start here? Didn't this start with the CME starting 5 days before last Friday, raising margin requirements, I think, 8 times in 5 days on the leveraged longs on the futures markets?
Yes, you're right. So what happened is the week preceding the big drop in gold and silver market, the CME raised margin requirement.
But only for the long side, though.
Only for the long side. Yeah, you're right. Only for the long side.
The shorts didn't have to raise their margin requirements. Cough, cough.
You're right.
Wink, wink.
So any of the speculators or the investors that went long and took leverage had to cover their margins, so they had to liquidate in order to cover the margins. So when that happened, the gold and silver prices had a big drop on that Friday onto Monday, which was the last day of the margin call.
Yeah, and then Monday, by Friday after that big drop, you knew Monday was going to be even worse because the technicals signaled further downside. All the support levels were blown out. You knew all the trend traders that had missed this move, 6 weeks, 8 weeks. Some of these smarter shorts had seen this move coming months ago, and they'd started to position themselves for a put bet. George Soros sold his GLD and was probably short. So, what we just need to, for our listeners out there, is that the Wall Street banks, a lot of the Keynesians and a lot of the Wall Street people will never like gold. Okay, so if you are buying physical gold, I mean, you don't care that much what the paper price is. You're going to buy more physical gold probably if you believe in the gold and silver bull market. So you're going to buy more physical bullion when the price drops. But the traders, they look at the chart and stuff like that. They don't really understand. I've spoken with a lot of Wall Street people in the last couple weeks on Seeking Alpha, which is where a lot of big shot Wall Street people post, and none of them know the real supply-demand fundamentals of the gold market. They just say the chart looks bad, gold's going down to 1,100 or below, blah, 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 blah. And it's just ridiculous. I mean, there will be a time here, Mo, where and this is where we should transition in this, I guess, because we've already talked about the feedback loop and how, all the margin calls triggered even more selling. The trend, the stops got blown out. The key support levels at gold, which were 1525, that got blown out easily. I think that didn't even hold. That was supposed to hold on the chart for a long time, Mo, and it didn't even hold for an hour or two. And yeah, exactly. And silver, the key support was what, 26, and that didn't hold 26. Either. Yeah, exactly. So these things just got blown up. I think everyone had their stops there, and the trend traders who are all short the market, all the traders are short the market, and they don't understand the fundamentals, the real supply-demand fundamentals of the gold and silver market, because I've spoken to enough of them, and none of them know the fundamentals. They tell me all the fundamentals are right there in the chart. Yeah. So anyways, though, let's just talk about now, Mo, how this affects the miners here, because let's be honest. I mean, even when gold was above 1,600 and when silver was around $20 to $30 an ounce, most of the miners, Mo, the primary gold and silver miners, I speak of, not the guys who mine the precious metals as a byproduct, they weren't making that much money. They were not generating free cash flow. I don't know if you agree with me on this, but of the gold miners I looked at, the primary gold miners, most of them, when gold was around 1,600, were not even generating around $200 an ounce in free cash flow. And most of the silver miners, when silver was around 28, they weren't even generating $5 an ounce in free cash flow. Is that what you saw in your analysis? Because I know you've been looking at companies along with me.
Yes, I have. And a good example of that is Silver Standard. If you look at Silver Standard operational results, they're all in, quote unquote, cash cost is $27, and right now silver between $23 and $24. So right now they are producing negative free cash flow at their mine right now. So that's one of the companies out there that.
And discuss the implications of being cash flow negative, Mo, with a company like Silver Standard who only has one mine in production. What are the company's options then? Because they're going to start burning through cash rapidly, right? Because they have a lot of debt on their balance sheet, right? So how are they going to cover that debt then? What are their options?
Well, one of their options is if the silver price stay at this level for a long time, which I don't think will happen. I think we'll see a big snap up rather quickly. Well, the worst case scenario is they could shut down their mine temporarily until silver prices recover. I've seen other silver miners when they mine the silver, they withhold the silver instead of selling it until the silver price goes back up. But I don't think
Yeah,
Silver can do that
Endeavor,
because they have a lot of leverage.
Exactly, Mo, and that's a good point because Endeavor Silver has multiple silver mines in production, and some of their higher cost silver mines, since they have multiple mines in production, and Endeavor Silver doesn't have much debt, they can afford to be more flexible here. So they can hold back some of that silver off the market if they think the price is too low. They can only mine higher grade silver. They can cut back on the lower grade silver from mining that because their margin is not good on that. So a company like Endeavor Silver has more options because they don't have as much debt on the balance sheet, whereas a company like Silver Standard, Silver Standard does have quite a bit of cash, but now they're cash flow negative, which means their burn rate's going to start accelerating because they're not profitably producing at the mine, and they're going to be running the mine at a loss, and now they just took on a lot of debt. So in terms of their options, Mo, they can sell assets because Silver Standard does have assets. The problem is some of their assets are only they're very low grade. They're high, a lot of ounces of silver, but they're very low grade. They're very high capex. Their next mine, Piteria, is projected capex at over $500 million. And the project economics they have put out for Piteria have only been economic for silver prices above 30. And that was before all these production costs risen. And you get a management team with Silver Standard, and there's a new operating team in the last, I think, 18 months or 2 years, where they haven't been able to increase their recovery rates. I remember when Pirquitas, which is their one operating mine in Argentina, the operating rates were supposed to be above 85% recovery rates on the silver. They were supposed to be all-in production cost, Mo, of $8 an ounce. And you said, what, their production costs are 27? So this is not a good situation. I mean, I don't know if Silver Standard will go bankrupt because a lot of that also depends if the silver price will come back. But they're going to start burning through their cash. They might have to sell some of their assets off for pennies on the dollar, and that's not going to create shareholder value. I mean, the company might survive, but you don't want to sell assets in these valuations, Mo, because the valuations I've been looking at for proven and probable gold reserves and proven probable silver reserves, they're even way less than in 2008. I mean, we are seeing proven and probable gold reserves now valued by the market, by sell-side analysts. They are valuing gold in the ground on a proven and probable reserve asset for a mining company at about $100 an ounce. And in 2008, when the world was supposedly going to end, that gold was still selling for $250 to $400 an ounce. So the valuations in this are as low as they've been in a long, long time in this industry.
Yes, and also another way the miners can somehow somewhat control the cost is to raise their cutoff grade for the mine that they pull out of the ground. And a lot of the mines have been doing that. If you look, I was going through the Morgan report, and he had a interesting statistic that said that the average grade per ton for silver has risen from 8 to 13. So a lot of the low grade are becoming uneconomical because of rising input costs and lower silver and gold prices as well.
Exactly, Mo. And even when gold was above 1,600 and silver was above 28, the miners were not really generating free cash flow. And that's the key. You need someone free cash flow, and that's why the royalty and streaming companies, your Silver Wheatons, your Franco Nevadas, your Royal Golds, your Sandstorm Golds, although Sandstorm doesn't have as many streams online, but they're extremely well run and they don't have any debt and they have pretty good free cash flow for a smaller company. Those are the companies, because of their business models, their management teams, their diversification strategies, who they do deals with. They're very careful about that for the most part. They put multiple escape clauses into the contract if it's a crazy deal. Those are the companies that are definitely going to survive this storm. that are going to ride out the storm because they don't have a lot of debt, Mo. Well, Silver Standard took on some debt. Not Silver Standard, I mean, well, Silver Standard did, but I'm talking Silver Wheaton. Silver Wheaton took on some debt, but it was an immediately accretive deal with Vale for a gold stream. So in general, you know, the regular mining companies have a humongously leveraged balance sheet compared to the royalty and streaming companies. So let's talk about then for our listeners, and let's give them an example of a good silver mining company versus a bad one, or you can provide some gold ones, Mo. I was looking recently at the income statements for First Majestic Silver versus Hecla, and they produced around the same total ounces of silver per year. And the differences are just really, really striking between how good the management teams are at one and how good the management teams are another, and how much more efficient a company like First Majestic Silver is compared to Hecla. And Hecla generated in 2012 over $300 million in total revenue, but their margins were absolutely horrible. Their margins were horrible, Mo. Their net profit margins were absolutely horrible. And you have a company like First Majestic Silver who generated $80 million less in total revenue than Hecla did for the same year, and they had way more net income. They had 4.5 times as much net income as Hecla did. So I think this is important for our listeners here if you are going to buy mining companies down here. And, you know, with lower prices, some of the mining companies, if prices stay lower, Mo, I mean, we could see some bankruptcies. We could. It's very possible because these mining companies, they're over-leveraged, a lot of them. Some of them have too much debt on the balance sheet. They can't control their costs. And, you know, they're either going to have to sell. They can't do any equity raises right now because their shares are already down, 70 or 80%. Some of them even more than that, especially the juniors. We were talking with Nolan Watson, well, in emails, but we didn't interview him yet. We're going to interview him soon. And his Sandstorm Gold people were telling me that they can't do any new gold stream deals with companies that have to raise a massive amount of equity right now. So it's just amazing how the market continues to get worse. And these are the signs of bottoms, Mo, right? Not that we're going to go humongously lower.
And yes, so we're, in the next year or so, we're going to see a lot of junior mining companies either go away, sell their assets for pennies on the dollar. And so what is that going to do for the supply side for gold and silver, for the investors that, you know, are still wanting to buy the silver and gold, and they're buying right now at all-time high. The demand right now is crazy. Some people say it's even crazier than what we had in 2008. And if you look at the premium right now for the demand in India, some of the premium the bank charges for gold is anywhere between $5 to $10. In China, $10. In Turkey, it's $20 over spot price. And in the U.S., if you look at the demand for silver, some of the premium for the silver eagle coins are anywhere between $3 to $5, which I haven't seen since I started investing in silver back in 2009. But I heard these numbers are similar to what happened in 2008. So when a lot of these mines are going to get shut down, and yet there's still an increasing demand for gold and silver, what does that mean? That means we're going to have a huge problem down the road in terms of supplies.
Exactly, Mo. And to add to your points there about the Silver Eagles, I mean, not only are the premiums that high, but people are having to wait 6 to 8 weeks to get delivery. For full disclosure for listeners here, I just nearly doubled my holding in physical silver. I bought a lot more physical silver this week because it was so cheap, because I've done the research on the all-in production costs for most primary silver miners and most primary gold miners, and the all-in average production costs for most silver miners are around $24 an ounce for many of the primary silver miners, and the all-in production costs for most gold miners are around between $1,200 and $1,400. I mean, you have Gold Corp, their all-in production costs, I believe, are around $1,100. Barrick is stating their all-in production costs are just under $1,000, but some of their financials indicate that's not the case. And if you look
at their free cash flow, it's in the negative. So they state their cash cost is $940, but yet they're in a negative in free cash flow. So
exactly.
Obviously there's something wrong there.
Exactly, and they're wasting money hand over fist. They've had humongous cost overruns on Pascua-Lama. That mine, which is on the Chile-Argentina border, humongous gold and silver deposit up there in the Andes Mountains, that thing was supposed to cost about $2 billion 4 or 5 years ago when it was initially started building, and now the capex, the amount of money spent on construction and all the other things, it's over $8 billion, Mo, and the mine's not done, and it's looking like there might be environmental delays, which could increase the legal bills and the other fees. They got their fees on their debt. They owe a humongous amount of silver to Silver Wheaton in a stream, so they're going to have to move other ounces of silver at other producing mines. They're going to have to deliver to Silver Wheaton instead. So this is not an efficient, for listeners out there, this industry has not been efficiently run in general. Now, there's been exceptions to that rule. You've had the royalty and streaming companies, which are extremely, extremely efficient with their capital, with their deals they do, et cetera, et cetera. And then you have a very small percentage, I would say less than 10% of companies out there that are primary gold and silver miners that are actually efficiently run. Those are like Yamana Gold, Keith Neumeyer's First Majestic Silver. A lot of the more well-run companies, Mo, I don't know if you'd agree with this, are the junior producers and the mid-tier producers because, they can't take on that much debt. They have to be more efficient with their decisions. And a lot of the cases, the people who started the company are the ones who own large inside percentage of the company. They're insiders. They own 8, 9, 10% or more of the company, and they want to make sure that their interests are aligned with the shareholders, and they're going to do a good job running the company, as opposed to some of these CEOs at like Barrick and IM Gold and Kinross and stuff who, came on, their employees are trying to make a big splash. They drastically overpaid for acquisitions, et cetera, et cetera.
And yes, for example, Hecla, they overpaid for one of those, the gold mine from Aragon. I believe they paid $800 million for that mine, which is
Horizon.
Horizon, way overvalued for that one mine.
And they took on a lot of debt, and then the gold price crashed. Whoopsies. Yeah, so the point for our listeners here is if you're going to buy regular primary producing gold and silver mining companies at this level, you better do some research. You could buy GDX or GDXJ or SIL because those are going to be diversified, and if one of the companies in the ETFs there fails, they'll remove it and replace it with a company who succeeds. And those indices will not go to zero. But if you're going to take on individual company risk, you need to do those analyses to look at how much free cash flow per ounce is the mining company generating right now, how much debt do they have on their balance sheet, how much cash do they have on their balance sheet. If their mine is not cash flow positive right now and not generating free cash flow, how quickly are they burning cash, things like this. And Mo, you talked about what this is going to mean. If the prices go lower or we have a correction even worse than this for another 6 to 8 months, it is going to be guaranteed then in 3 to 5 years from now, we're going to have a supply shock because the real supply demand fundamentals for the market, it's just enormous still. The central banks are still buying. The investor demand is still there. On a day, when people are saying that the gold bubble and silver bubble burst, right? Why are there 2 or 3 hour lines in Hong Kong, Shanghai, Beijing? There was 2 or 3 hour lines in Australia. I heard there were lines that long in Switzerland, which is surprising, and Canada. And, a lot of the online bullion dealers, Mo, they sold out of almost all the popular product. So this is not indicative then of a bubble bursting. This was a paper price smash. Now, maybe it was justified, the paper price smash, because the technicals were bad. But Mo, over the last 6 to 8 months, right, didn't on the charts, gold and silver nearly broke out 3 or 4 times starting in August of 2012. Remember us talking about on past podcasts about that beautiful cup with a handle on a chart, how the cup was there and the handle had started and the higher volume was coming and we were about to break out and then all of a sudden it just got smashed back down.
Yep, and us and a lot of other experts like David Morgan have been calling for a bottom in the gold and silver market as well, and it just never happened. We had this big collapse in the price, and that tells you that in the silver and gold market, technical analysis does not work very well because of the market intervention. So people need to be very careful when they see, there's a bottom and they go long, or they see a top and they go long, or they go short because this market is so manipulated. It's just hard to predict what's going to happen in the gold and silver market, which is why I stopped looking at the chart for now. Until I see some clarity in the market.
Exactly, Mo. And since February, a lot of Wall Street investment banks like SocGen, which is a French one, Citibank, and then Goldman Sachs in the last week or so, they've all come out with negative reports saying that there is no inflation here in the United States, which is laughable. There is some inflation, clearly, especially in consumer staples. Consumer discretionary is not, because the consumer doesn't have declining discretionary income. But, you have the Wall Street banks saying all this stuff, and, they wanted the gold price down. And like I said, for the justification purposes, they said there is no inflation. The U.S. economy is recovering. I don't see a lot of signs the U.S. economy is recovering. Maybe some industries are recovering, like the banking sector is getting free money. Healthcare is getting free money. Real estate industry and home builders are getting more free money, and Congress is papering over their losses, so the home builders continue to start building houses, et cetera, et cetera. So,
some of the technology sector are doing well as well.
Yeah. So there is a few sectors out there that are doing pretty well. But
yes.
In general, though, a lot of the sectors are not, they're not really doing that well. So let's talk then about physical demand and where the miners fit into all this. So the all-in right now, for our listeners out there, if you go to Seeking Alpha and look at Heba Investments, he wrote a couple articles. These are some key articles. We'll put the links to them in the text box of this podcast. Talking about the all-in production costs for gold miners and the all-in production costs for silver miners. Essentially now, listeners, you are buying metal at or below the production cost for most miners. So the silver miners are working very, very hard now to produce that silver for you to buy, and you are buying it for below their cost. That is obviously not sustainable in the long term. Look at other past commodity markets, right, Mo? Let's give our listeners some examples of how this played out over a couple-year span. Natural gas, right, was at 2. It crashed. It was at 16 when the U.S. was supposed to be a natural gas importer, and then we had because the natural gas prices were so high, they started doing horizontal drilling and hydraulic fracturing on shale, right? And then all this natural gas supply, because the price was so high, and it crashed it down to 2. And then people were like, well, there's so much natural gas, it'll never rise. Well, the natural gas producers weren't even making a profit, right, Mo? So eventually they were going to turn off supply, right? Some firms were going to go bankrupt, and a lot of them, to survive, were going to turn off supply and start hoarding cash and wait for the price to go back up. And what has happened in the last 2 or 3 years?
So what happened, for as of now, the U.S. natural gas prices is made in 21 months all-time high.
Exactly.
And now, if you look at the natural gas companies, a lot of them that either shut down or they reduce their inventory in natural gas. Now they're turning it back on, and now they're generating a profit now. And some of these natural gas companies they look a pretty good company to invest in, because now they reduce the supply and the demand is going back up, and now we're seeing a little bit of a boom in the natural gas prices.
Exactly, and they rode out the storm. So you're seeing the similar thing now in uranium, where a lot of the uranium miners are mining the uranium below their production cost. They're selling it below their production cost. So that's not sustainable either. So what we're saying, our listeners out here, we really care about you guys. We don't want you guys to lose money. We're realistic about the possibilities in the short term for gold and silver prices to go lower, but long term, demand for metal, for real metal, not paper prices, is increasing. I have not seen any statistics saying that demand for real metal has decreased. Are you seeing anything like that, Mo, saying demand for metal is decreasing?
No, I mean, I'm reading all these bullion dealers putting out articles, and a lot of them are saying 50 to 1 buyer to seller ratio for gold and silver. I've seen 5 to 1, 50 to 1, 10 to 1. So nobody's selling.
And central banks,
everybody's buying.
Yeah, and the G20 central banks are still buying. The G7 central banks, which are the developed countries who are all running currency wars and QE programs and inflation targeting and nominal GDP targeting with financial repression, where they keep the interest rates on their bonds low. They print currency to buy their own sovereign debt to keep the interest rates low. These guys are all trying to sell or release their gold into the market to prevent their currencies from, their bond market from spiking and their bond markets blowing up. And they're willing to devalue their currencies. So, yes, in the short term, there might be more pain, there's probably going to be, if this correction continues longer for at least another 6 months, I would expect there would be some bankruptcies, some of the more inefficient firms. But the royalty and streaming companies are the most efficient. There are some other firms, if our listeners out there are interested in some paid consulting work, we can help them pick out the more efficient regular miners that when things do rebound, they're going to go up a lot. And, our listeners just need to be very careful. I mean, this is a time here where I think the metal is some shares are good values. You can buy put protections still if you're worried about that, although now it's going to be expensive. You could have bought it weeks ago, and it would have been much cheaper to buy a married put on your long positions. You can hedge that way. You can hedge with inverse ETFs or other things. But the metal is so disgustingly cheap. So all I'm going to do, guys, I have cash flow coming in now, is if the metal price for silver, if it goes, another $2 or $3 lower, my orders for metal are going to increase. And, if the miners cannot earn a profit, firms are going to go bust. They're going to cut back on supply. And then we're going to put a very strong bottom in the market then, because there still is demand. And in the price 3 to 5 years from now, there's not going to be, juniors are not going to get financing, as Mo said. Some of the miners that are already in production are going to be more hesitant to take on debt, and they're not going to bring on supply as quickly as they would have in the past, especially with Barrick, because, on this dip, a lot of the larger gold mining companies, Mo, like Barrick and Kinross and I think IM Gold, their debt was just downgraded to junk by credit rating agencies, because the credit rating agencies are saying if gold is below 1,400 for a long time and even below 1,200, that some of these companies, their reserves that are listed, their P2 proven and probable gold reserves are not they're not economic at gold prices if they go lower, and in some of the mines are going to be cash flow negative. So this is how, you what's the term? You cull the herd, or you trim the herd. The fat is being trimmed now in this industry. There was way too many juniors. There was a bunch of geologists who were, collecting fancy salaries and, taking first-class vacations, first-class plane rides, going in suites, and they're wasting a lot of shareholder money, and they weren't finding any gold or silver. So that has come to an end, Mo. I don't think, from talking with Rick Rule, I would be surprised if the top 5 or 10% of juniors is left remaining after the end of this.
But this should be a happy time for a lot of precious metal investors, because you can get all the mining shares and the metals for a very cheap price. I mean, none of us thought that silver would be below $25 ever again after it went up past 30 a year ago.
Exactly, Mo. And one thing, you and I have looked at hundreds of projects, PowerPoint presentations from gold and silver miners. Over the last few years, almost all the gold mines that have been brought into production, really since 2009-ish, they're not economic below $1,200 an ounce. And that was the plan. Once gold, broke 1,000 and it clearly, started rising, the miners started bringing on more and more marginal gold deposits. I guess they took on debt to do it, or they issued equity or whatever, or a combination of the two. And a lot of those ounces, like I said, you've just had a lot of global quantitative easing. And it's not just the U.S. It's all the other countries on dollar pegs. It's Japan now. And it's just compounding inflation in the global supply chain. I mean, costs have risen for some of these miners who haven't been able to control their costs 10% or more per year for 5 years now almost. So that's doubling of costs, right, in like 8 years or 9 years.
And yes, and what's interesting is when we started looking at the mining sector for gold and silver, a lot of our top picks like Pan American Silver, Silver Standard, Hecla, Coeur d'Alene, all these companies used to be our favorite silver companies, and now they're not anymore.
Their management, they used to have low cost, Mo, and their management teams to try to get growth, like they've made some really bad decisions with their capital.
Yeah, so you could see how when you make the wrong decision, how quickly you can become a good company to a bad company. And unfortunately, these companies are no longer our favorite silver mining stocks. And so it tells you how hard it is to build a good mining company in the precious metal sector, because it is hard, because there's a lot of factors out there that they can't control, like inflation costs, energy costs, and some of their input costs they can't control. They can do
or the government changing the rules on the tax structure, like in Guatemala or Mongolia or something. Yeah, that.
Yeah, so there's a lot of factors that they can't control. A real good company might be able to maintain or control their cash costs, like First Majestic, and keep it at a stable level. But most of them they just don't have the expertise, or they're not long-term thinkers on how to combat these problems. And that's what we're seeing now in this industry. And so I think in the next few years, a lot of these companies are either going to go away or get bought out or go bankrupt, as we said many times in this podcast in the past half hour.
Exactly. And around, $1,200 an ounce gold, over 30% of the world gold production, in my estimation, is not really economic anymore. And I'm hearing the people on the charts tell me that the technical and analyst guys, and these guys are just trend followers, they're saying gold could go down to 1,000 or below. There's 50% of world gold production is not economic at $1,000 an ounce anymore. It's just not. And the demand is from China, and these guys are still rising. So something has to give. Something has to give, and most likely that's going to be certain miners going bankrupt and miners, shutting off production and starting to hoard cash to save themselves. So in wrapping things up, Mo, the business models, the most efficient ones, the companies that can ride out the storm, our listeners really have to look at the income statements, and they have to look at free cash flow, the statement of cash flows, and look for free cash flow. What companies are able to generate free cash flow in this environment? Because that stops that you don't have to go and take on debt at really high interest rates. You don't have to issue any equity, which is dilution, or more shares for listeners out there. You don't have to issue any more shares when your stock price is already down 80 or 90%. That's a death sentence. I mean, the company will survive for a little longer, but it's just very stupid to do it right now. And the four best companies to do that, and I've talked with a lot of experts about this, is clearly, it is not just, well, it's my own opinion, but this is talking with a lot of other experts, is the royalty and streaming companies. These guys are going to survive. These guys, the baby has been thrown out with the bathwater so badly. A company like First Majestic Silver, First Majestic is a good mining company, but Silver Wheaton, got over a 2% dividend yield. They've grown revenues massively, Mo. Even though the silver price has gone from 49 back down to 23, their revenues have still massively grown. Okay?
And they still have healthy profit margin because their silver cost is fixed.
Exactly. They have over $15 an ounce in free cash flow at these prices.
Yep.
So, yes, some of their partners, a couple of their streams may shut down. Who knows if the prices do go lower? But they're not going to lose all their streams, and they don't have that much debt on the balance sheet. So these are the types of companies, Franco-Nevada, Silver Wheaton, Royal Gold, Sandstorm Gold. Those are the companies that are going to survive the storm.
Yes, there's going to be a very, very small percentage, but it's healthy for the industry to see consolidation and mergers and acquisitions, because the companies that survive are the ones that are most likely to be able to take these mines, pull them together, and get them into production if they are economical.
Exactly, Mo. And then, the ones that were smart, that didn't try to grow too quickly during the last boom, that were smart about their growth, like a Yamana Gold, Yamana didn't try to grow too quickly. They grew efficiently. They only put like a 120, 130 ounce gold mine into production each time in a while. And those are going to be the guys that last. Those are going to be because they have cash, and then they're going to be able to go buy assets there's a lot of good assets out there, Mo, with low valuations. People with cash are just salivating right now. There could be a very big merger and acquisitions in the sector where the big guys swallow up the smaller ones. But the thing is, the valuations, the premiums on the valuations are not going to be good. So if you own the little company and it gets bought by the large one, you're not going to get a big premium then in this market.
And that's correct. And so to summarize this podcast, what we've been discussing is the big divergence between the fundamentals, the supply and demand fundamentals in the paper market. The demand is so high right now. It does not reflect the big crash we had in the paper market. So any investors out there...
Keep stacking metal.
Exactly. So any investors out there that are long-term and they're or fundamental investors should look at what's going on in the supply and demand.
Yeah, I don't buy metal as an investment though, Mo. I buy it for insurance and wealth preservation. So I just see it as like I have a lot of cash, and I want to trade some of my cash for bullion because I want to maintain my purchasing power. So I don't see buying physical silver really as an investment.
Yeah. And we also discussed the mining industry and how this big drop affects them, and we talked about how because the price dropped so low, some of them are going to start to produce negative free cash flow. So in result, that could mean that some of them could temporarily shut down their mine until prices goes up, or some of them could withhold selling the gold and silver until the price goes up, or they could raise their cutoff grades, and so that makes some of their reserve uneconomical. And also, if it stays like this for 6 to 8 months, we could see a potential supply shock in the gold and silver market in 3 to 5 years. And also, the investors out there that are still trying to invest in the mining sector, a lot of them should look at the royalty and streaming companies like Silver Wheaton or Sandstorm Gold. And if you're looking at the mining company, they should make sure that these companies have no debt, they have positive free cash flow, and it's growing. They have growing revenue, and they have good growth, and the management team is doing a good job.
Cash on the balance sheet, some cash on the balance sheet, yeah, and their debt levels are not too high. Because, I mean, most regular mining companies, Mo, have some debt. There's very few with no debt. But they have to
and also they have to... I'm sorry. Go ahead.
But they have to have a good amount of cash in the balance sheet, just in case they have to shut off a mine, so they can afford to wait the storm out if they have to shut down a higher cost mine.
Yes, and make sure they're able to maintain their production costs as well.
Exactly. So hopefully our listeners enjoy this and like it, like the podcast if you thought this was entertaining and you learned something and helped you. And feel free to comment or send us an email if you want to talk about production costs. Because obviously this might the correction might last a year or two. Who knows? I mean, I've been wrong before, especially lately. I thought after QE3 and QE4 the gold and silver price were going to rocket higher, and they didn't. So I admit to being wrong. I'm not perfect. If you look at other industry experts besides myself, they haven't been right calling this market either.
Nobody has been right, so it's okay.
Yeah. But what we want our listeners to stress our listeners is that this is not permanent. It's not, because the supply-demand fundamentals, as Mo said, for physical metal are improving. They just are. The miners are not producing for profit right now, so they're going to be forced to become more efficient. And you got to be careful if you invest in mining companies or whatever, which ones to buy, and just keep stacking metal because you're buying the metal now below the production cost. So, as long as that continues, I'm going to keep buying metal. It's just that simple.
Yeah, same here. So if anybody wants to check out more of our podcast, they can go to www.wallstreetformainstreet.com, or they can go to our YouTube channel. Just type in Wall Street for Main Street. And also check us out on Twitter and on Facebook. So until next time, everybody have a good week, and good luck trading and investing during this rough time.